Welcome to Kitco News. I'm Niels Christensen. Gold continues to struggle to find direction even as uncertainty surges through financial markets. Here to talk about her outlook for the global economy and gold prices is Kristina Hooper, Chief Global Investment Strategist at Invesco. Kristina, thank you very much. It's a pleasure to have you on the show again.
Great to be with you, Niels.
So let's just jump right into this. Last time we talked, you said, you see gold prices trading in a fairly wide range. Everything's sort of going to depend on this recovery. We've seen some interesting data come out in the last couple weeks. I wanted to get your thoughts. Do you think the hopes of a V-shaped recovery is growing? Do you think this is misplaced optimism? What are you looking at the moment?
Well, it seems that hopes are growing on the margins, but the market is fickle. And what's happening is that on a day-to-day basis, we're seeing data and news flow impacting where markets go. For example, on a day when we get good news about possible progress in the development of a vaccine or therapies, we see expectations of a V-shaped recovery. And how do we know that? Because we see cyclicals and smaller cap names outperforming other parts of the market. But on most days, what we see is a stock market that anticipates a slower, more uneven recovery. Think of it as a Nike swoosh or a square root symbol. And that's typically when we see defensives and secular growth perform better. So we are in an environment where definitely optimism is improving about a V-shaped recovery. But to your question, it's probably misplaced.
So then what do you think? Do you think is gold, I know last time we talked, you said, sort of gold is in fair value. Do you think that's the case? And I'm sort of wondering, I asked you this question before as well. What do you think is going to be needed? What's the catalyst to push prices out of this current range?
So gold has had a really nice run up, and I believe it's in this trading range and is likely to stay in it unless you get some kind of significant catalyst. And it could be along the lines of some dramatic rise in infections, information that suggests that a second wave of the virus would be more serious than a first. Think back to the 1918 Spanish flu and how much more severe and dangerous that second wave was. But also geopolitical issues such as the flaring up of tensions. For example, what we saw just a few days ago with North Korea and South Korea. If that were to really get worse from here, that could also be a cause for gold to go up. So there are a variety of different catalysts. If we look back to the 2016 presidential election, we saw gold going up on concerns about a Trump presidency. And so anything can really be a catalyst for gold going higher, anything that is viewed as somewhat disruptive.
I guess one of the things people are looking for is inflation, and really wanted to ask you this question. Everybody says inflation is going higher. Risks of inflation are rising. However, in the last 10 years, sort of at the last financial crisis, they sort of said the same thing, and we didn't see that happen. And I'm sort of wondering, I know inflation is one of the things that you look at too. So I'm wondering, what do you think makes this this time different? Does inflation pose a bigger risk than, what we've seen in the last few years?
I'm not sure this time is different. Let's look at inflation from a monetarist perspective. It's all about the supply of money and the velocity of money, right? And that theoretically should cause an increase in inflation. Well, during the global financial crisis and in the aftermath, of course, the money supply went up, but we saw companies hoarding cash. And so we didn't see that velocity of money that was needed to really spur inflation. So, if you're a monetarist, you're probably going to assume that that scenario will repeat itself, just given the cash hoarding we've seen thus far. Now, that could change. We'll want to follow that closely, but I think that the likelihood of a rise in inflation is lower than a pretty low level of inflation, which is what I would expect at this juncture. Now, if you look at it from the perspective of, say, a Janet Yellen, or those that believe wages and wage growth have a big impact on inflation. Now, keep in mind, Janet Yellen was such a purist about the impact of wage growth on inflation that she had created this 19-point labor market conditions index. Well, we have just dramatically high unemployment. That's unlikely to change anytime soon. So we're unlikely to see any kind of significant wage growth. Now, I will give the caveat that in the April jobs report, we did see significant wage growth, but for the wrong reasons, because we lost a lot of lower paying jobs. But real wage growth, probably not going to happen in any significant way. So from that perspective, I'd also say it's less likely that we see any kind of big move up in inflation.
So I guess gold investors should be paying more attention to its safe haven luster more than an inflation hedge in the near term, I guess.
I think so. I mean, certainly the break-even rate on inflation has improved since the bottom in March, but the reality is that there are a lot of different factors impacting gold prices. I wouldn't focus on inflation as the one likely to move gold up from here.
While we're talking about, sort of the monetary policy and want to get your thoughts on, the Fed last week and their signal that they want to leave interest rates low for the next 2 years at the zero bound range. What are your thoughts? I mean, and do you think they can achieve that? I mean, do you think they're going to have to start controlling the yield curve, like some people are speculating, to achieve this goal? And is it a realistic goal? Sorry, a lot of questions there to peruse through.
Let me try to answer them. Well, first and foremost, I think absolutely the Fed can hold rates low for several years. We saw them do just that in the wake of the global financial crisis. Now, keep in mind, though, that the dot plot we saw last week was just a policy prescription from Fed members as they looked out at this juncture. So just like an inflation could change, this could change as well. But what I believe the Fed has done by lowering rates and suggesting that they will keep rates low for extended period of time is to make assets like gold look more attractive. The opportunity cost of owning gold goes down when the Fed funds rate is in the range that it is now in. It's just a lower opportunity cost.
Obviously, we've talked a lot. You do like gold. It does, that safe haven factor. Sort of wanted to get your opinion about the miners in this environment. I mean, if gold's in a new uptrend, do you like the miners as a leverage play?
Well, I look at gold for the benefits it provides in a diversified portfolio. And one of those benefits is diversification, that lower correlation with asset classes like equities. And so I would favor physical gold as opposed to gold miners because you just don't get that diversification. Now, gold miners, one might want to own them for a variety of reasons. But for those like me that are looking at a portfolio and looking for diversification, they just don't hit the mark the way physical gold would in terms of providing lower correlations or lower historic correlations.
This has been a fantastic conversation. I wanted to ask you one more question before we go. This is trying to find a consensus, especially in this environment. I've asked this from a number of fund managers. What's the right allocation for gold, do you think? Everybody sort of talks about that 5 to 10%. And I'm sort of wondering, in this environment, should you be more towards the 10% or above that even? As we see, interest rates being held at the zero bound for potentially the next 2 years?
That's a tough question to ask because I think it really depends on the investor profile, their tolerance for risk, their need for diversification. So I do think it's really appropriate to look in that 5 to 10 percentage point band. But having said all that, for those who are particularly concerned about geopolitical risks, are particularly concerned about the potential for the pandemic to worsen, for infections to spike, that would probably lead them to the higher end of that 5 to 10% range.
Kristina, as always, it's just fantastic to talk with you. Thank you very much for coming on the show.
Thank you, Niels.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe, stay healthy.